Groceries are up. Rent is up. Insurance is up. Fast food costs what a restaurant meal used to cost. And yet, your paycheck doesn't feel up. So what's going on? Did companies suddenly get greedy? Did money just break? Or is there something bigger happening behind the scenes? Today, we're breaking down why everything feels expensive, what inflation really is, and most importantly, how to protect yourself from it. Because if you don't understand inflation, it will quietly drain your wealth for the rest of your life. The problem: why this actually matters. Most people think inflation just means prices go up. That's true, but it's incomplete. Inflation doesn't just make things expensive, it makes your money weaker. And here's the mistake people make. They focus on earning more instead of protecting purchasing power. Purchasing power is simple. It's what your money can actually buy. If you made $50,000 in 2015 and make $50,000 today, you are effectively poorer because $50,000 today buys less than it did back then. Inflation is not loud. It doesn't send you a warning email. It doesn't show up as a bank fee. It slowly erodes value. And most people don't notice until it's too late. Section 1. What inflation actually is. Simple explanation. Let's make this simple. Inflation is the rate at which prices rise over time. If inflation is 3% per year, something that costs $100 today will cost $103 next year. Doesn't sound scary, right? But here's the compounding effect. Over 20 to 25 years, that $100 item could cost nearly double. Inflation compounds just like interest does. Think of inflation like a slow leak in your financial bucket. You don't notice it immediately, but over time, the bucket empties. Now here's the key idea. Inflation is not about higher prices, it's about lower money value. Prices are just the symptom. The real issue is currency purchasing power declining. Section 2. Why prices won't stop rising. 3 core causes. Now let's break down why inflation keeps happening. There are 3 main drivers. 1. Too much money in the system. When governments and central banks increase the money supply, there are more dollars chasing the same goods. Imagine 10 people bidding on 5 concert tickets. Prices go up. Now imagine 20 people bidding on those same 5 tickets. Prices go even higher. That's inflation. More money, same supply, higher prices. During crises, governments often inject money to stabilize the economy. Stimulus checks, low interest rates, bond buying. Short term, it helps. Long term, it increases inflation risk. 2. Supply shocks. Sometimes prices rise because supply drops. Oil disruptions, war, pandemics, shipping problems. If supply shrinks but demand stays strong, prices increase. It's basic economics. Less supply plus steady demand equals higher prices. This happened heavily in 2020 to 2022. Factories slowed, shipping stalled, demand bounced back faster than supply. Result? Price spikes. 3. Wage price spirals. Here's where it gets interesting. If prices rise, workers demand higher wages. If wages rise, businesses raise prices to maintain profits. Now we have a cycle. Higher wages, higher prices, higher wage demands. That loop can sustain inflation longer than expected. Section 3. The hidden impact on your life. Inflation doesn't hit everyone equally. It hurts savers. It hurts fixed income retirees. It hurts people holding large amounts of cash. Let's say you keep $20,000 in a checking account earning almost nothing. If inflation runs at 4%, you lose $800 in purchasing power in 1 year without touching it. That's invisible erosion. Now multiply that over 10 years. This is why simply saving money is not enough. You must grow money faster than inflation. Section 4. The solution. 5 practical ways to protect yourself. Now let's move from theory to action. Here are 5 practical strategies. 1. Increase your income, but strategically. Inflation means your income must grow. Ask for raises, develop higher paying skills, build side income. But here's the key. If your income grows 5% and inflation is 6%, you're still behind. Track real growth, not just nominal growth. Nominal means the number on paper. Real means adjusted for inflation. Always think in real terms. 2. Invest in growth assets. Cash loses value. Assets can grow. Historically, over long periods, stocks have outpaced inflation. Real estate often adjusts upward. Businesses can increase prices. The stock market is not perfect. It fluctuates, but over decades, it tends to outgrow inflation. If inflation is 3 to 4% long-term, your investments should aim to exceed that. This is how you stay ahead. 3. Avoid lifestyle inflation. When you earn more, don't instantly spend more. Inflation already pressures expenses. If you inflate your lifestyle too, you double the damage. Instead, increase savings rate first, then upgrade gradually. Control fixed expenses, housing, car payments, subscriptions. These are silent wealth killers. 4. Use debt wisely. This one surprises people. Inflation can actually benefit borrowers. If you lock in low fixed-rate debt and inflation rises, you repay that debt with cheaper future dollars. Example, you borrow at 3%. Inflation runs at 6%. In real terms, your debt is shrinking. But this only works with fixed rates. Variable rates can rise with inflation, so be cautious. Debt can be a tool or a trap. 5. Think long-term. Inflation cycles come and go. The 1970s had high inflation. The 1990s had low inflation. The early 2020s saw spikes. The key is consistency. Don't panic sell. Don't hoard cash long-term. Build diversified investments. Stay patient. Compounding works over decades, not months.
Section 5. The inflation illusion. Why it feels worse than the numbers say. Here's something that confuses people. You hear on the news, inflation is 3%, but your rent jumped 8%. Your car insurance jumped 15%. Groceries feel 20% higher. So what's going on? Inflation numbers are averages, and averages hide reality. If steak drops in price but rent rises sharply, the average might look moderate, but you can't stop paying rent. You can switch steak. You can't switch housing easily. This is called weighted inflation. Different categories impact people differently. If you're a renter in a major city, your inflation experience is very different from someone who owns a home with a fixed mortgage. If you drive a lot, gas prices hit harder. If you're on a fixed income, food inflation hurts more. Inflation is personal. That's why some people say, it's not that bad, and others say, this is crushing me. Both can be true. The lesson? Don't rely only on national numbers. Track your personal inflation rate. Look at your biggest expenses: housing, food, transportation, insurance, healthcare. If those categories rise faster than official inflation, your strategy needs adjusting because your life runs on your budget, not national averages.
The alpha tip. Most people miss this one. Here's something most people don't understand. Not all inflation is equal. There's headline inflation, that includes everything: food, energy, housing. Then there's core inflation, that removes volatile items like food and energy. Why does this matter? Because central banks make policy decisions based on core trends. Markets react to expectations, not current pain. So if you want to stay ahead, watch inflation expectations, bond yields, interest rate projections. Markets move before inflation shows up in your grocery bill. That's the insider layer. Inflation isn't just about prices today, it's about expectations of tomorrow. Position yourself before policy shifts. The bigger picture, why inflation is normal. Here's something important. A small amount of inflation is normal. In fact, central banks target around 2% annually. Why? Because mild inflation encourages spending and investing. If prices were falling constantly, deflation, people would delay purchases. That slows the economy. So inflation isn't evil. uncontrolled inflation is. The goal isn't zero inflation, it's stable, predictable inflation. Final perspective. Control what you can. You cannot control Federal Reserve policy, global oil supply, government spending, geopolitical conflict. You can control your skills, your savings rate, your investments, and your financial education. Inflation punishes the passive, it rewards the prepared. If you understand how money works, inflation becomes manageable. If you ignore it, it becomes expensive. Closing. So next time you feel like everything is expensive, remember, it's not just prices rising, it's purchasing power shifting. And the people who understand that shift position themselves ahead of it. If this breakdown helped you understand inflation clearly, hit like, subscribe for real financial education without hype, and drop a comment. What expense has shocked you most recently? Because awareness is step 1, strategy is step 2, and financial confidence starts with understanding the system. See you in the next one.